So these are the general changes that are not really, doesn't matter if you're a C Corp, S Corp, partnership, kind of universal changes. The big one, so 179, 179 is the ability to buy an asset and depreciate it all in year one. They also had something called bonus depreciation, and that allowed for assets that you couldn't depreciate under 179, you could get an additional depreciation. Basically, we're front loading the depreciation. They moved up the 179 from 500,000 to $1 million. Really, that's going to be less critical for the next 5 years because they've changed the bonus depreciation from 50% to 100%. So what does all those numbers and everything I said mean, right? Basically, you got a company that buys $3 million of machinery. Last year, they would have got maybe $800,000 to $1 million in depreciation, maybe a little bit more depending on the facts. They get to deduct the whole $3 million in year one. Whether they financed it, for our bankers out there, right, that's what they're hoping for, or they paid for it cash. And so if you take a company that buys $3 million worth of stuff and finances 100% of it, because people like Gerardo will give you 100% loan on anything you buy, you had no cash outlay, but you saved what could end up being 1.2, 1.3 million in tax in that same year. Now, you have no tax deductions moving forward, and you have the cash outlay, so it's just a timing difference. But it's a good way if you're looking to kind of spur the economy and kind of push it forward. It's going to increase spending. I think this is where a lot of the investment stats are coming from. Our people are looking at their tax planning and saying, if I'm thinking of doing this, I can really affect my tax bill. So the bonus is one of the items that does phase out before the 10 years. So I think as we get to the later part of the 10 years, the 179 will become more useful than it is probably in 18 and 19. Another change, cash method. So before, there were certain limitations where you can only remain cash on a cash basis for a period of time. They moved it up to 25 million. One big misconception is, well, if I'm on a cash basis method, I don't have to keep track of inventory. That is not 100% true. You still have to look at some of the facts because there are cases where you can be cash basis, but you still have to track inventory. Business interest limited to 30%. So this is basically interest expense can't exceed 30% of a calculated number. We'll call it EBITDA. It's not quite that. Most of our clients say, I don't have that much interest expense. It doesn't matter. I look at my financials. Interest is only, 1 or 2%. But you got to remember, with all the depreciation going up top, their taxable income could get to zero, and that interest could get limited in that year. It does carry forward, but for highly leveraged companies, that is something that could have impact.